Well, shifting focus now to the energy markets, the Iran war is creating a sharp divide in the U.S. energy market. As disruptions through the Strait of Hormuz tighten global fuel supplies, American refiners are reporting a surge in profits and shareholder payouts. For American consumers, however, the picture is very different. Gasoline prices are still higher than they were before the war started, adding to household costs. So who is benefiting from the supply shock and who is paying the price? Take a look at this next report for more.
The disruption to global oil supplies since the Iran war began has created a major windfall for U.S. refiners. Marathon Petroleum, Valero Energy, and Phillips 66 made a combined $12.6 billion in profits in the second quarter, their highest combined profit since Russia's invasion of Ukraine in 2022. The key driver has been tighter global fuel supply. Disruptions to crude shipments through the Strait of Hormuz combined with attacks on Russian refineries have reduced available supplies and pushed up fuel prices and refining margins. The three companies returned $6.3 billion to shareholders through dividends and share buybacks in the quarter, more than double the amount returned a year earlier. And investors are betting that the cash flow will continue. The supply squeeze has dramatically increased the spread between the price refiners pay for crude and what they can charge for refined products. That has translated into higher returns for refiners, but also higher costs for consumers. The average US gasoline price is now around $4 a gallon, compared with nearly $3 when the Iran conflict began. An analysis cited in the report estimates the average US household has already spent around $610 more on gasoline and diesel since the war began. Despite easing inflation in July, analysts believe energy remains the most critical factor for the average American.
So going forward, one of the most important things to keep an eye on will be energy prices. For one thing, that is something that weighs very heavily on the minds of consumers. It's less direct of an impact to the Federal Reserve's view because it's part of it's one of the volatile components, not part of core inflation. However, it does, if it stays persistently elevated, energy costs do filter through to other categories. You'll see it quickest in something like airfares, where, those will move when gas prices move. But really, energy is an input to everything. So it will eventually filter through to those core categories if it remains an elevated cost for some period of time.
The refining boom is also visible in the stock market. Marathon Petroleum shares have gained about 110% this year. Valero is up more than 98%, and Phillips 66 has risen around 75%. The S&P 500 energy sector, by comparison, is about 36%. The result is a sharp contrast. Energy companies are generating record cash flows, while households face higher fuel bills. That has triggered political criticism and renewed calls for measures such as temporary fuel tax cuts or windfall profit taxes. But refiners argue that their capital allocation decisions are driven by shareholder obligations and market conditions. The broader question is whether the supply disruption will persist. If Hormuz remains constrained and global inventories stay tight, refiners could continue benefiting, but consumers would remain exposed to elevated fuel prices. Business Bureau, WION World is One.